Hello everyone, welcome to today's US Open live session. It is the first day of February, 10 minutes before Wall Street opens. As always, I'm your host Nikos Tsavouras, Senior Financial Editorial Writer at FXCM. It's been an eventful couple of days since our last session, as we had the Fed laying the groundwork for a pivot, but also warning that it's not ready yet to cut rates, and this strengthened the US dollar, while today the Bank of England also made a step closer to an eventual rate cut, but it's far from that. It called for a sustained, prolonged stance in a bit of a mixed outcome, I would say. We also had a series of earnings. So these are the main events that we will be talking about in today's session, and of course their impact on Euro USD, GBP USD, and the Nasdaq. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and the disclaimers. I'll give you a few more seconds to do that, and then we will begin. Okay, let's get the ball rolling. We have quite a few things to discuss. Hello to our friends who are sending hi on the chat. If there are any opinions on what we discussed today, please feel free to type them through the chat, or if there are any questions regarding what we are talking about. So we are going to start with the latest development, the Bank of England. Then we're going to talk about yesterday's decision by the Fed. And then we will discuss their impact on the British pound versus the dollar, the euro versus the dollar, and of course, the Nasdaq 100. So let's bring up the charts. Here we see the progression of the interest rates in the UK, and of course the CPI inflation on the bottom part of the chart, just as a backdrop of what we're talking about the Bank of England, which maintained rates at 5.25% for fourth consecutive meeting as expected. Officials dropped the previous warning for further tightening if needed, hinting essentially at the end of hikes. Instead, they now said that they will keep under review for how long the bank rate should be maintained at its current level of 5.25%. On the other hand, policymakers clearly advocated for sustained restrictive stance and actually raised their inflation forecasts despite seeing a temporary fall in the next quarter. They expect inflation to fall below target in 3 years. That's longer than what they previously expected. And on top of that, even though they made a step closer to an eventual pivot, they did not signal such a thing. They said that it's essentially too early for such action, and there were still 2 members voting in favor of a hike in a typically divided BoE. All in all, it was a bit of a mixed outcome for a central bank that has been plagued by poor communications and divisions amongst its members, also highlighted by today's vote count. Of course, the central bank has a difficult task. You can see on the bottom part of our chart that inflation has been dropping significantly despite the recent uptick, but still remains far from the 2% target at around 4%. I don't know what you make of this decision. If you have any thoughts, feel free to type them in the chat. And now let's talk about the Fed. Uh, the US Central Bank has been shifting towards a less hawkish stance, and the December projections imply 3 rate cuts this year. Yesterday, policymakers stood pat on rates again. You can see how they have kept uh, rates at 5.5. The last high was all the way back in July, and they took another step towards normalization. The statement essentially pointed to the end of tightening, the tweak in the policy statement. And Chair Powell said that policy rate is likely at its peak. That's a dovish shift compared to his December comment, where he had said that it is near or at or near, actually, its peak. He also embraced lower rates, saying that it will likely be appropriate to begin dialing back policy restraint at some point this year. However, the policy statement also read that the committee does not actually the committee, I'm sorry, we're having some technical issues. Don't know if the sound broke. Sorry for that. But as we said, however, the committee does not expect it will be appropriate to lower rates until it has greater confidence that inflation will fall substantially towards the 2% target. You can see it has various measures, but you can see on the chart that the core PC just dropped below 3%. The headline, of course, is lower, but has not still reached the 2% goal. And Chair Powell put cold water on hopes for a March cut. He said that he does not think it's likely that the committee will reach a level of confidence to actually move and cut rates as early as March. So although it laid the groundwork for a pivot, it pushed back against aggressive market pricing and said that it's not ready to actually deliver such cuts. And of course, this disappointed aggressive market bets and held the dollar higher. Now, with that said, let's take a look at the British pound versus the US dollar. It dropped yesterday and remains under pressure today, despite immediate reaction higher after today's BoE outcome. The fact is that the Bank of England did not signal cuts, and markets seem to, at least currently, pare back their pricing for even a May cut by the BoE. The pair has been lacking direction over the past several weeks due to this rate uncertainty. It breaches critical support levels. You can see that it breaches the 200 period EMA, the black line, and the 23.6% Fibonacci of the last leg up, which started around October. This is the area right here that we're talking about, and it's actually a critical support area, and this creates a risk for further fall to the December lows and the 38.2% Fibonacci at around 1.5. So that we could see something like that here. However, it seems that there is some protection on the downside. If we switch to the daily chart, you can see that we have a daily Ichimoku cloud and the 200 a thick daily Ichimoku cloud and the 200 days exponential moving average. Back to the 4-hour chart. Um, as we said, the daily Ichimoku can provide support technically, but also fundamentally, the Fed is closer to lowering rates than its UK counterpart, and both could be supportive. So it turned above 1.28 looks likely, but the next major resistance would be quite far, actually. You can see here above 131, the next major resistance, and the pair definitely does not inspire much confidence at this stage, but chances of deep losses is also not very easy. But of course, we also have upcoming events that could determine the trajectory. Now let's pivot to Euro USD. We talked about the Fed. Last week, we had the European Central Bank, and we analyzed that, but let's have a refresher, let's say. The European Central Bank has also ended, looks likely it has ended its tightening cycle after 450 basis points of cuts of, sorry. Last week, they stayed on the sidelines and hinted again at rates, have, however, maintained a more hawkish stance around next steps compared to their US counterparts. They said that interest rates need to stay at current levels for sufficiently long duration to restore price stability. And although they too expect lower rates this year, they appear more reserved. President Lagarde stood by recent remarks which hinted towards a summer cut, but warned that it's premature for the Governing Council to discuss such action. So definitely a more hawkish ECB compared to the Fed. The greenback strengthened as Chair Powell essentially ruled out a cut at the next meeting, and the pair extend its poor start to the year. Immediate bias is on the downside, and Euro USD is in risk of breaching the December lows, which are located at 1.072. But we are cautious around further losses that could tackle 1.106 around that level. All in all, the policy differential is a bit murky between the ECB and the Fed, but the latter has more clearly communicated its intention to pivot compared to the ECB. Furthermore, markets have not totally priced out a March cut by the Fed. Despite yesterday's dismissal by Chair Powell, they still see roughly a 40% chance of a March cut. These factors can support Euro USD and give it the chance to retake the 200 period DMA at around a little below 1.09. That's the region here. But the common currency does not inspire confidence at this point for sustained strength towards and beyond 1.1. So that's pretty much it for the US dollar as well. And now let's switch gear and turn to the Nasdaq. The tech-heavy index took a hit over the last couple of days due to the Fed outcome and cold water over aggressive market expectations for a cut at the next meeting. And because the first batch of tech earnings underwhelmed markets. Alphabet, Microsoft, and AMD all fell after their results. There were various reasons for that, but overall, the overarching theme around these companies is that markets want to see that AI and their investment in AI is leading to better top and bottom lines, and this has largely not been the case. Microsoft has already seen an uplift, but Alphabet seems to be far from that, can't make a clear connection, and AMD has just only now entered the AI chip arena, which is dominated by NVIDIA. The index pulled back over the last couple of days. You can see here, this is the pullback we're talking about, and the pullback of which we had actually warned in our last session. This exposes it to the critical 200 period EMA. 200 period EMA is here at around 16,890. Daily closes below it are required to pause the bullish momentum, but strong catalysts would be needed, and the downside appears well protected. On the other hand, the results of the aforementioned companies were generally solid, and market still expect multiple cuts by the Fed, as we said, and have not totally priced out a March cut either. So bulls remain in control and look poised to tackle the 18K mark, even if they need a little more time. Of course, there are key events coming up that will determine the trajectory of the tech-heavy index, including mega cap earnings of of Amazon, Meta, and of course Apple. We've already covered this in our previous session on Tuesday, and we focused on Apple both in regards to what to expect from these earnings, but also its technical setup. And the truth is that the earnings come at a bit of a tough period for the company. Now, what else we have ahead? We have the US NFPs on Friday. The labor market is coming into better balance, but remains tight, as per Chair Powell, yesterday's comment. The last print had shown 216,000 jobs added in December, which was the highest print since September. So another set of strong data could make it harder for the Fed to start cutting rates and sort of add on top of yesterday's dismissal of a March cut by Chair Powell. So as we head toward the end of our session, if there are any questions or any opinions of regarding what we discussed, feel free to type them in the chat box. So all in all, just to wrap things up, the Fed laid the groundwork for a pivot, but clearly stated it's not ready yet, and that helped the greenback. On the Bank of England front, there was again some dovish elements, as the central bank essentially pointed to the end of hikes, but clearly called for sustained restrictive stance and did not signal a cut as many participants would have hoped. Looking ahead, we have tonight US mega caps reporting results, Meta, Apple, and Amazon, and tomorrow we have the NFPs. So